Good afternoon, ladies and gentlemen. It's good to be here with you, not in person, but at least in a webinar. My name is Aisha, and we have met before, face to face or through webinars. And I'm delighted to be here today with you. And it's always great to come and talk to yourselves, get your views, get your questions, and to the best of our ability, answer those questions and as many questions as we possibly can. Before we begin, I really want to acknowledge the current environment across the Middle East region. Of course, our foremost priority at this hour is the safety of yourselves, your families, and your businesses. And please be assured that we remain fully committed at Standard Chartered to supporting you with continuity and care during this time. So our operations are running smoothly. Our frontline teams and support teams and all of us in the management teams are here to support you during this time. And of course, the safety and security of our colleagues also remains very, very important to us. Here in the UAE, we are fortunate to operate in a market that continues to demonstrate resilience and strong global connectivity. Those of you who are here are already witnessing that. That makes staying informed and well-positioned more important than ever. From my perspective, what matters most in moments like this is having a trusted partner. And I hope that you find ourselves at Standard Chartered as your trusted partner, whereby we're helping you navigate through this uncertainty and give you some clarity and confidence. That is why we are exactly here today. We've met you a couple of times since the conflict began on the 28th of Feb. And we are delighted to have the session with yourselves today as well, in light of the latest views on the recent developments and to explore what these could mean from a global markets perspective in terms of your portfolio and how you should be navigating through this environment, what challenges that are still lying ahead, what opportunities should you pick up right now, and how you see our house views, which have evolved over time, landing with your individual portfolios. And this time, to provide their insights and perspectives, I'm delighted to inform that we have our Global Chief Investment Officer, Steve Bryce, who's with us here today. Many of you have met him before in live sessions, and Steve is here joining us from Singapore. So Steve, thanks for joining. And with him, we have Manpreet Gill, who you have also met before, our Chief Investment Officer for Europe, Middle East, and Africa. And to help moderate this session, we have Pratibha, who's not free from questions because I'm going to take questions from yourselves and ask her the questions, as she also heads our managed investments and advisory for UAE, Europe, Middle East, and Africa. I really encourage you to submit your questions via the Q&A button as we aim to address as many of these questions as possible. We've got some questions from last time as well, and the team's put those together, and we'll bring them across the board as well. So I wish that you have active participation during this call and ask your questions. We're going to take as many questions as possible, but Pratibha has already lined up a lot, both for Steve as well as for Manpreet, specifically in light of the Middle East situations and the changing environment and the changing context and the different dialogue that we're all reading constantly on socials as well. So I'm going to pause here and give it to Pratibha so that we're going to start a very informed conversation with Steve and Manpreet. Pratibha, over to you.
Thank you very much, Aisha. Good afternoon, everyone, and a very warm welcome to all of you for joining us today. I know many of you have been watching the news with a great deal of concern over the last few weeks, and we've been trying to bring to you our views regularly over the last few weeks as well, since the conflict began. When conflicts escalate in your own region, it's not just about an investment question, but I think it gets a little bit more personal. At the same time, I know that as investors, you want clarity, a framework for thinking about what comes next, and also an honest guidance on what to do with portfolios. That is exactly what we're here to do today, and I'm very glad that Steve could also join us today in our session. So thank you very much, Steve and Manpreet, for joining us and being here to share your views. I think our clients would agree that there has never been a more important time to hear your views. So let me start with this. Manpreet, maybe start with you, as we've been answering these questions in terms of scenarios. The headline question is that it's now 3 weeks since the conflict has started. and the Middle East, conflict has rattled markets. But your base case obviously still assumes that it is going to be short-lived. What gives you the confidence in that view? And is there anything that has changed your mind on this? Can you walk us through all our scenarios that we basically shared over the last few weeks and how that's kind of evolved over the last 3 weeks? Thanks.
Sure. Thanks, Pratibha, and good afternoon, everyone. You're right. I think since the start of the conflict, and we've held the view that we see about a 70% chance that the conflict lasts weeks rather than months, approximately 4 to 6 weeks, as our base case scenario, and only about a 30% probability to that downside scenario where this conflict, but also the disruption in oil prices last much, much longer than that. And at the moment, sitting here today, we still hold the view, right? And that 70% probability. And where that's coming from is really trying to step back and look at, the incentives of the various players involved. Because I know this is very hard to do when you're in the middle of it, particularly if you're based in the region and directly affected by it. But the question we've been asking ourselves is what incentives the various players, and particularly the US, has to either keep a conflict short or potentially get into something more prolonged. And we continue to be of the view that, while there are days, it doesn't feel like it, but the incentive for the US in particular is to ultimately find a way to limit this to being a relatively short-lived conflict, at least to the extent that the rise in oil prices is not so long-lasting that it has a long-term impact on inflation. That is one of the reasons, if not the only one, why we think this is still weeks rather than months long. Now, if we're right about that scenario, then of course you can see that our long-term base case macro scenario, in our mind, would still hold. Because the rise in oil prices, which is really the main channel back to financial markets, what can potentially cause disruptions for equities, bonds, currency markets. In that first case scenario, the rise in oil prices only lasts a few weeks, and we relatively quickly come back to a world where oil prices, head back lower. Perhaps not all the way, but at least a large part of the way back before we started this conflict. And that's a world where it's plausible, if you step back and think about it, for the Fed to go back, especially in the second half of the year, to focusing on some of the other, what might seem like boring financial market data, right? Where the unemployment rate is, where the inflation rate is. And to our mind, that's a scenario where we return to a world where the focus is more on what we still think is a pretty soft US job market. And which is why we think that's a world where the Fed is still able to cut rates at least a couple of times in the second half of this year. And that's, as you can see in the middle column here under the 70% probability, a world where the dollar resumes its weakness, bond yields potentially move a little bit lower, and gold, of course, is still a good asset to hold alongside equities as what we see as a top performing asset classes, right? That we're sort of overweight equities and gold. Now, what I will concede, of course, is that there is a 30% scenario where this does not work out quite as we expect, and a more prolonged conflict that ends up resulting in a more prolonged disruption to energy supply, right? Whether that's actual shipping or production facilities or storage. And that's one where the market outcome could, of course, be very different because, a more prolonged, what matters is not so much where oil prices go, but, most importantly, how long they stay high. Because, in a scenario where the conflict is months long could lead to much higher average oil price, which would make it much more difficult for the Fed to cut rates. Inflation would be more of a concern. So while we still think an asset class like gold can perform well, and I know there'll be many questions around that one, that's an environment which may not be quite so supportive for equity and bond markets. So at the moment where we sit, we still have confidence given recent events that 70% base case scenario holds. Nothing wrong in putting some hedges in place against a downside scenario, but this is why we wouldn't alter long-term portfolios at the moment. Because we still see a good case that we return back to a base case macro scenario by the time we get to the second half of the year.
Thanks, Manpreet. I think that's very useful start, right? So going by the base case, and this was also published in our Global Market Outlook, assigning 70% probability to a short-lived conflict, which will resolve in 3 to 4 weeks, does the Monday, 5-day ceasefire window vindicate that view, or does that back and forth nature of this conflict make you more cautious? Has this changed the probability distribution at all?
Well, I think on its own, it does support our base case view, right? And it supports the rationale of the view, more importantly, to say, look, we expect this to be limited, because we think one of the key players, which is the US, has an incentive to ultimately find a way to impose some sort of time limit on this conflict to ensure it doesn't become prolonged and result in a prolonged period of very high oil prices. But I think you'll all agree with me that I think it's equally dangerous maybe to sort of base a view on one day's events. We have seen this back and forth before. We've seen it sometimes on the same day if you follow Trump's Truth Social channel. So I think it's about accumulation of events. I think it's a good sign, no doubt, that some form of conversation is happening. And I think that is what I take on a more sustained basis as a positive sign for a base case scenario. Obviously, there's enough for the pessimists as well for a 30% downside scenario that the timelines happen to coincide with the arrival of more troops in the region. So it's natural to be skeptical. But what I would just take away from it is the fact that the pressure from energy prices, the US desire to keep any conflict and the disruption to energy markets relatively contained. I think those are the factors that feed into the rationale for a base case view. And like I said, not to over-rely on one or two factors alone, but that trend appears to be at least heading in the right direction.
Yeah, maybe Pratibha, just to add to what Manpreet said, obviously we totally agree with that. I think one of the things that is becoming very clear is that part of the TACO trade that everybody talks about is market dependent. So let's say markets were 10% higher, bond yields lower, oil price lower come the end of this week. I'd actually be more worried about how Trump might react in that environment. So I think there is this sort of interaction between markets and Trump, and he's obviously trying to manage that to some degree. But the more he's able to manage it, the more likely it is to be more prolonged, I guess. So that's just something I think we just need to factor into our decision-making process as well.
Oh, thanks, Steve. I think that is very critical at this point, given that we've seen how these things have evolved over the last few weeks. Let me just hop on to another critical point, right? We've been talking about the Strait of Hormuz over the last few weeks. Suddenly, that's become the highlight of the overall situation. Even with a temporary pause, the strait has not formally reopened to full commercial traffic. How should clients think about oil price risk over the next 5 days? And is there still meaningful downside to go, or is much of the good news already priced in after Monday's drop? And we've seen the oil prices come off below 100 now. Maybe Manpreet, if you could start. Thanks.
So I can start. I think on oil prices, it feels a little bit like market pricing is almost adjusting day to day in oil markets in response to the latest event or comments out of the White House. So I would argue, and this is more an estimate rather than any arguing for any specific level, but it does feel like we've got some good news at least on Monday, and we've got a significant move lower in oil prices. And on Brent, perhaps is the one to follow here. I think more representative global markets than WTI or US oil prices. But I think we already got the move back towards $100, where we're now seeing a pause, a little bit of a rebound. So that argues that some of the good news, or at least that partial probability that this could now go in the correct direction, does seem to be in the price. But if I step back and think about it from a market perspective, right, and linking it back to our scenarios, if we're right about a base case scenario, then eventually this should move back lower, perhaps not all the way back to $60, but at least, at some level back in, at least well below $80, if you go back to the very first scenarios we put out. But, the time period it takes us there could still result in an average price of the quarter being still quite high, which is why on a 3-month basis, we think it's plausible for prices to be in the region of $75 over the full period. Clearly a lot higher than that in the beginning, but over 3 months moving that to $75, also countering the fact that storage is high. You turn the conflict off tomorrow, it'll still take several weeks before shipping, storage, production can really come back to normal. So I think that's what the slightly higher oil price does reflect. In the very short term, though, just to the point we were discussing on the previous question and what Steve mentioned, I think it does, prices haven't come back to $100 doesn't mean that they can't go back up in the very short term. It will just need another comment on Truth Social or X, and we could very well be back at 110 or 120. So not a bad time to put on a short-term hedge if you are thinking in terms of very short-term. But I think you're sort of clearly in a range of $100 to $120. Think about, a more pessimist outlook a few days ago, and a more optimistic one. That seems to be where we are. And I think to really move us out of this, Either things will need to get much worse to move us back above 100 and 110 to $115, or we'll need to see some tangible progress on these negotiations to really bring Brent sustainably below $100. That's how I look at it.
Thanks, Manpreet. Steve, if I could just maybe shift the focus to inflation, right? Clearly, I mean, all of this oil conversation will eventually lead there. But the conflict has pushed near-term inflation expectations sharply higher, yet you still expect the Fed to cut rates by 50 basis points in half two. How do you reconcile these two things? And is the Fed effectively stuck between an inflation spike and a weakening job market? And also, if I can add in, the latest developments from Monday, does that change the Fed's calculus meaningfully? And do they need to see the conflict fully resolved before they act?
Thanks, Pratibha. So I think there's a lot there, right? So I think that obviously the initial thing is everybody's been focused very much on the inflation expectations element to this. So that's the left-hand side of this chart. So you can see the 1-year inflation forecast, if you like, at 3.3%. That's up sharply from just obviously 3-4 weeks ago. Well below what we were seeing actually a year ago. So from that, or about getting back to levels that we saw about a year ago. But so it's not catastrophic, but obviously it is going in the wrong direction as far as the Fed is concerned. And they clearly have backed off from any near-term potential easing. I guess the way that I look at this is if you look at the two scenarios. So let's say that 70% probability scenario takes place. Then we see oil prices coming down over the course of the next 3 to 6 months, probably back towards $70 a barrel or something like that. It will take a while, I think, for the Fed to sort of believe that's more longer term. But that would obviously then reverse the expectations in terms of higher inflation, especially over longer term. And you can see the 5-year, so a 5-year forecast of inflation has actually been very, very muted. So that will reassure the Fed, but obviously they would want to see inflation pressures ease significantly in that environment. Then in the second half of the year, they can start refocusing, obviously with the change in leadership at the Fed as well, on the growth aspects of this, which you can see on the right-hand side, as you mentioned, the job market has been pretty weak in the US, partly due to weaker demand, but also obviously weaker supply as well, with the immigration crackdown, if you like. If you're in the 30% scenario, obviously people will be a bit more worried about that inflation picture being more sustained, but I think it would lead to much weaker growth as well. So the question is, how much would the Fed be able to look through that? I think it's just that would just be a timing issue. So we would see that the Fed would ultimately have to force, because if you see oil prices above $100, $110 a barrel over the next 3 to 6 months, I think recession fears would increase, and ultimately that would bring down price pressures and obviously then lead the Fed to cut interest rates. So I think that's the sort of scenario. So that might only happen, obviously, be delayed back into 2027, the rate cut cycle in the 30% probability scenario. But we do think ultimately it would come down. So I think from our perspective, the way I'm certainly looking at this is we've seen a massive reevaluation of interest rate expectations around the world. The UK is probably the biggest epitome of this. Where they were going from looking for cuts to looking for hikes in a very short order. We think this positioning has skewed very, very significantly, and they're starting to actually give some opportunities for investors in terms of locking in longer term yields. But ultimately, we do still see the Fed cutting rates. It just depends on which scenario plays out as to when.
Thank you, Steve. Again, maybe moving further on from inflation to some of the asset class views, right? Monday was a textbook buy the dip day for equities, if I may call it that. But markets surged on the ceasefire news. But this window obviously is temporary and fragile. For clients who possibly missed that rally, is it still the right call to add equities here? Or has some of that opportunity passed?
Yeah, I think look, these things always matter your time horizon, right? So this is just an example of what happened in the Iraq conflict in 2003, 10-day returns and 30-day returns. You can see that normally markets do bounce back, even actually, and then this is obviously different sectors, but you can see how different areas of the market performed. I think we would expect the markets to be higher by the end of the year than they are now, based on our scenarios that we've plotted out earlier. The only thing is, I would say that this conflict is more concerning than certainly than 2003, and than generally we see, because obviously there's three actors. So I mentioned in a piece I put out on Monday, one of the titles that resonated with me, it takes two to tango, but the reality is it takes three. So you need US, Iran, and Israel all to negotiate and agree something. That's going to be pretty challenging. This is an existential threat as far as the Iranian leadership is concerned, and that's how they're certainly viewing it. So how can they believe when Trump strikes a deal? To what extent do they believe that deal is there? I mean, he's already torn up one in terms of the nuclear agreement Obama agreed with them. And obviously he was at the negotiating table twice when the bombing started. So I think they would be, there's going to need to be some sort of way that Iran either can get greater comfort from the US and Israel that any negotiated ceasefire would be held, but also then also retain the right that if it's not held, then they have the power to shut the Strait of Hormuz again. So I think that's the challenge. I think so from the way I'm looking at it, I don't think the volatility is over. I don't think we've seen necessarily the low for markets, and therefore we could see another wave of risk off before we actually get to the negotiating table proper. So that's my central scenario.
Thanks, Steve. So staying on equities itself, and specifically US equities, they've actually been remarkably resilient, right? Outperforming since the conflict began. Do you attribute this to the US being a net exporter of oil and AI-driven earnings momentum? Is this resilience sustainable as well? And is US technology still a buy after YTD underperformance?
So I guess US is generally usually low beta. When it comes to risk-off environments, it generally outperforms. So it has obviously sold off to some degree, but it underperformed year to date up until that, and actually still is underperforming. I guess when it comes to tech, we are still bullish. So people who joined us for previous events earlier this year will have seen this chart. We've obviously updated it as well, but this is just basically, to our point, showing that there isn't a bubble in US tech. So that you can see the bubble, the gap between relative earnings and relative performance in the end of the 1990s, but there's no such divergence. And you can see that earnings growth is actually now cut through the relative performance. So actually, market is underperforming what the fundamentals would argue they should do. And we've been upgrading our CapEx plans for the tech sector. So at the beginning of the year, we saw a 40% increase in tech CapEx. Now we see it as 54%, and that should support earnings growth in a forward-looking basis as well. So this is just consensus estimates for earnings. Obviously, these will be revised given what's going on in the world today. But you can see that very, very strong number that's put in the technology space for this year, still strong next year. Obviously, these are just forecasts; they can change. But for our mind, the fundamentals still are supportive. So as soon as the situation stabilizes, as soon as we start to see inflation peaking, interest rate expectations reversing, then we see tech resuming its outperformance trend, and we have aspects within that we prefer. So we prefer semiconductors, for instance, and internet. Software has obviously been beaten up. It's been pretty brutal and across the board. Signs of it getting a little bit more nuanced now, but software probably still not. We're certainly not calling buy the dip on the software sector as a whole. But tech we still believe in and think it will outperform.
Thank you, Steve. Manpreet, if I could just maybe move to you and direct the question around Asian equities, right? We have had a call on overweight Asia ex-Japan, but particularly Japan, India, Korea, all of these countries have borne the brunt of the oil shock given the region's energy import dependence. Um, Monday's drop in oil should obviously provide some relief, I would assume. Do you now have a higher conviction on Asian equity buying opportunity? And also, where specifically should one be adding? Would that be India, China, or Taiwan?
So, look, great question. I think what I'll start by saying is that I think it's no surprise that we have seen some of the biggest selling relative to other regions in Asia, because when you think about the implication of high oil prices, this is one of the more import-sensitive parts of the world economy. And I think that applies for most, if not all, economies in this region. But I think there's that's only one side of the story. And I think the other part is if you look at where some of these dots sit on the chart, I think that two extreme maybe examples I'd call out is one is Korea, Korean equities, which of course are energy dependent, but clearly the weakness has been a little bit larger than you can see the rest of the cluster. And I think that to some degree is a result of the fact that they'd actually gone up so much, in the past year. So a much higher starting point, a much higher longer positioning. And similarly, the opposite for Indian equities, right, which one would have normally expected would have fallen actually by a little bit more than the others, given the scale of import dependency. But given how bearish sentiment already was at the starting point, we've seen that fall being perhaps a little bit muted than one would have normally expected. So I think all of these sort of come together and sort of say, look, yes, no surprise, we're seeing some weakness. And if we're not at sort of peak market volatility just yet, we could very well see a bit more two-way volatility on a lot of these markets. But I think going back, sort of linking this back to our conversational scenarios, right? I think if we're thinking about this in our base case scenario where all of this, ultimately linked to oil prices and that volatility is, limited to several weeks further, then yes, each bout of volatility, whether it was, some of the peak bearishness late last week or whether we get another bout of that in the coming days, those would represent great buying opportunities for long-term investors. Recall that when you think about our long-term portfolios, we are overweight this region for a variety of reasons. And I think our approach has been to put on short-term hedges exactly against this kind of volatility. But if you put on your long-term investor hat for a moment, and if you agree with our base case scenarios, then it makes sense to use this volatility to build some of that long-term exposure. And actually, this second chart sort of speaks to some of that long-term picture, right? Because I think what's equally interesting is in all this volatility, we've seen the dollar rise, but the dollar index ultimately paused at around 100 and not really move sustainably above that. And in our base case scenario, we'd expect dollar weakness to resume. And as the long history of Asian and emerging market equity shows, that's usually a pretty positive sign for Asian equities. So absolutely, we do think in our base case, this is a good opportunity, particularly on days when we get the most pressure on sell-offs for the region as a whole. And obviously, our preferred markets within that, Chinese equities, Taiwan equities in North Asia, and Indian equities as well. Those are the markets we prefer for the earnings growth in North Asia and for just how consensus bearish in the outlook seen on Indian equities, at least on a relative basis.
Thanks, Manpreet. Maybe just a quick pause and to let our listeners know that they can drop in their questions directly to Steve and Manpreet in the Q&A chat box. I do see some coming in, so I'll pick that up just now in a bit. But moving back to you, Steve, from our latest global market outlook that got published, you're closing the India large and mid-cap opportunistic idea after a near 10% loss. Yet you remain overweight on India from an overall perspective. Can you maybe help clients reconcile that? And is India still a conviction call over the medium term?
Yeah, thanks, Pratibha. So very simply, they just have very different time horizons, and we risk manage them differently. So the mid cap, large cap exposure is a short term trade, and therefore it had fallen 10%. So we decided to close that out and just take our loss and move on. So that's just risk management. The overweight to India is much more. It's just a longer term view. So from an asset allocation perspective, we feel that the fundamentals are changing. So you can see we saw a derating we saw earnings slow, obviously 24, 25. Expectations are strong this year, and obviously, again, as mentioned earlier, that might be revised a little bit lower in the face of what we're seeing today. But overall, we see a much more positive picture for Indian equities from a earnings growth perspective, assuming obviously that the 70% scenario holds. And secondly, we did see a derating in stocks in India as well. So you've got improving fundamentals, reduced valuations. So we're below mean valuations now. From a long-term perspective, we're not massively cheap, of course, so we have to factor that in. But overall, we believe in the structural story for India, earnings picking up, and also valuation cheaper. So for us, from a 6 to 12 months perspective, an overweight to India still makes sense.
Great. Thank you, Steve. We do have a lot of clients asking about India all the time, so that adds a lot of perspective. So thanks a lot. Just maybe moving on to fixed income as an asset class. And I do see a question there in the chat box as well. But firstly, from our latest GMO publication, again, you've upgraded DM high yield, the developed market high yield bonds, to an overweight position at a time when credit spreads are widening. And also there's stress in the private credit space that's emerging. Why is this the right moment to lean into high yield rather than retreat to higher quality bonds?
Yeah, maybe I can take that one. Look, I think the reason we think this is an interesting time is partly linked to the fact that spreads are getting wider. Because in my mind, for high yield, there are two sort of factors at play here. One is credit quality itself, right? And that in recent times has not really been a concern, and that continues to be the case where we're not really seeing a significant worsening of credit quality indicators. So that really provides some comfort, but I think it helped explain why spreads were so tight. If you recall, even 3 to 6 months ago, it was getting harder and harder to find any value in the corporate credit space, whether investment grade or high yields. And I think that leads into the second factor that, as we've seen these spreads sort of start to widen, we're starting to get perhaps not a huge amount of value, but at least the prices seem to have come off their extremes, and we're getting a little bit more value to lock in that spread and yield. Normally, one would expect credit quality to get worse if you hit more of a a recessionary sort of environment, particularly in the US. But as Steve laid out, that's not really where we are. So we're getting strong credit quality and slightly better value. We think that's a good time to lean in. It's similar to the argument about why we use some of the volatility to add to equity markets. So that, in our mind, is really the rationale and why we think it makes sense as part of a portfolio. What I would say, and this is on the next slide, is that where we think high yield overweight makes sense is part of a broader basket of income assets or yield-driven assets, because we're overweight high yield, we're also overweight emerging market bonds, both in the dollar and the local currency space. And that basket, combined with the fact that dollar yields themselves are a little bit higher, we just think is a great time to lock in the income, given the opportunity on both the yield side as well as the credit spread side. That basket makes you less dependent on just one factor alone, but high yield exposed you more to those credit spreads and a more US or US plus Europe sort of tilted credit quality, which we think remains attractive, remains in good shape. But also emerging market dollar bonds, they offer you a good mix, almost 50-50 of commodity exporters and commodity importers. Actually, less sensitivity compared to Asian equities. And local currency bonds, we think that's obviously a small tilt. It'll always be smaller, but that actually gives you more direct exposure to US dollar weakness, which we expect to resume. So together, and you can see the numbers on the screen and the yield you don't expect, it just feels like a good opportunity to lock in some of those yields if that's your own investment goal.
Maybe just on private credit, just quickly, I'm cognizant of time and we want to get to questions, but look, there's lots of negative news out there, right? And in the 2026 outlook, we highlighted two concerns that people have. One is potential contagion to the banking sector, which we think is not. Private credit has obviously grown dramatically, but it's not big enough to threaten the banking sector in any way, shape, or form, in our opinion. So from that perspective, we're not too worried. The second concern, which we were more concerned about, was too much money chasing too few assets, or you can think about it as being not amateurs in the market, but lesser professionals in the market, maybe. And I think that's what we're seeing at the moment. So we're seeing publicly listed business development companies, which are the ones that manage private credit, They've obviously come to a significant discount to net asset value. That's leading to contagion in terms of redemption requests in the private BDCs as well. But our sense is, staying with top tier managers, which is where we've been focusing our views, is still fine. We still like, sorry, I haven't put the chart up, but this is the sort of spread chart of the private credit over even high yield. So we still see this as an attractive area from a structural perspective, but there's going to be a lot of noise between now and certainly, in the coming months. So we still see this as an attractive area, but if you're expecting it to be a noise-free environment being invested in private credit, then think again.
Thank you, Steve, Manpreet, and thank you, Pratibha, for moderating. And can I encourage the audience to please plot in your questions? I'm picking up your questions, and I'm going to ask one of the questions right here, which has come through. And Steve, if you could take that, and then Manpreet, if you could add that, how do you see the GCC bonds performing in the future? Because obviously, the audience that is here have got exposure to GCC bonds and overall Middle East bonds. Should one invest now as the prices are down? And where should the investors be looking at in light of, we've already talked about the Fed rates in relation to the impact on the GCC bonds? So that's the first question. And there's lots coming around the Strait of Hormuz and impact on currencies. I'm going to ask that just after this one on the GCC and Middle East bonds is taken. Steve, over to you.
Okay, thanks, Aisha. Maybe I'll start with the sort of the dollar interest rate view and the treasury curve, and then Manpreet can talk about the GCC markets in more detail. It's his area of expertise. So look, we've basically been arguing in US government bonds, 10-year yield above 4.25 is quite interesting. Right, so of course there's a risk that we can get up to 4.5, but this is it's a good time in our opinion to start increasing allocation to US dollar bonds just generally, because the all-in yields suddenly start to look a lot more attractive, generally speaking, outside the region. So last time I checked, we're about 4.35, I think, on the 10-year yield. So I think from that perspective, it makes sense. But maybe I'll hand over to Manpreet to talk about the GCC bonds specifically.
Sure. Thanks, Steve. So I think if you think about the spread, the credit spread over and above the higher US bond yield that Steve just mentioned, I broadly divide GCC credit into two big picture categories, right? I think the real opportunity sits in the higher quality sovereign and sovereign linked bonds, because these are ultimately credits that are very, very high quality in nature. And it's not just about, obviously, oil prices themselves, but these are, credit sovereigns with considerable financial reserves. And it's interesting that you've seen, no surprise, a lot of analysis across the market in terms of what the impact of the conflict could be. But actually, most of those point in exactly the same direction as is our own view, that, quality remains extremely high, which is why it's almost a little disappointing the spread widening has not been as much as, let's say, what we would have liked if one wanted to enter. But I think if you're seeing even a moderate sort of widening in spreads when it comes to sovereign and sovereign linked, the highest quality ones, I'd absolutely see that as an opportunity to add. Let's not forget that somewhat ironically, higher oil prices can actually help sustain some of the credit quality as opposed to lean against it in the current context. I think the area to obviously be a little bit more cautious about, there are two I'd mention. I think one is we're seeing obviously some interest in some of the higher yielding parts of the market, so low credit quality but very high yielding bonds. I think that's always an area to be cautious, and not to say there can't be some great gems in there, but that's always a company bond by bond discussion. At a broad sweep level, that's obviously an area we still be quite cautious on. I think the opportunities in the high quality as opposed to the low quality bonds. And the second is actually, I just be careful about duration. Because obviously, even when it comes to the highest quality credits, we're not so worried about the credit quality. But there is a difference when you go back to our scenarios between, say, 5-year bond and a 30-year bond, just to pick two extreme examples, because where our view is, of course, to focus more on the 5 to 7-year maturity bucket. We think that's a great sweet spot between earning what we think is an attractive yield, particularly today when yields and spreads have gone up, while still having some exposure to the likelihood that yields come down. The risk with very, very long maturities is that if we do end up in a downside scenario or markets worry about inflation even temporarily, then the volatility on those extremely long maturity bonds can be quite high. So those are the 2 points of caution. But I think, notwithstanding those 2 points, I think when it comes to the high quality sovereigns and the companies linked to those, I think that's an area where I think it's absolutely worth looking for opportunities at this point.
Thanks for that, Manpreet. And I know that we're on the subject of fixed income, but there's also, a lot of interesting questions coming through around the currency impact. There are conversations around Strait of Hormuz being open for as long as payments are made in Chinese yuan. Then, as a result of that, how do we see that balance shifting? And obviously, the US dollar is also reacting to gold and oil, but this piece around a possible currency shift for payments to be made in Chinese yuan, what impact is that going to have, and how should investors react to that?
So
Manpreet, you first, and Steve, then please give us a tip, or either way.
Okay, maybe I'll start, and then Manpreet can add the sensible comments afterwards. So I think from a payment perspective, the numbers in reality are fairly inconsequential, right? So $2 million in CNH per ship. Let's just take that as the going rate, if you like. It's going to be material for Iran, but it's not going to be material, I think, for global FX flows. So from that perspective, now psychologically, of course, it can have a greater impact. But I think the way that we would sort of think about this is saying, we in our scenario that we see this as being short-lived, and we see the straits reopening anyway, even with payments. Maybe that's the way that this plays out. Who knows? Then the dollar is likely to lose its safe haven status and decline, and that would be against most currencies, including the Chinese renminbi. So from that perspective, we still believe the dollar is going to come lower over the coming 6 to 12 months. So we'd be selling into rallies, and that would be including against the Chinese renminbi as well.
Sure. And thanks, Steve. And maybe just a couple of points I'd add is one is, of course, on the US dollar, which I think Steve already touched on, that sorry, I meant to unmute there. This is obviously a scenario where the dollar weakness does come back. So I don't think it necessarily sort of interrupts our long-term FX views, which I think have much, much bigger drivers than a single sort of channel. I think on the question on whether this sort of feeds into long-term de-dollarization, which is where I suspect this question is coming from, I'd argue it doesn't, move the needle in a big way, right? Because at the end of the day, Iran's incentive here is the fact that it's under sanctions, has been for a long time. So, finding non-dollar alternatives will always be interesting. But if any end deal involves, some easing of sanctions, some or complete easing of sanctions, then that incentive goes away. And then you go back to the big picture argument about, well, look, even mainstream oil producers, even before all of this started, were still pricing oil in dollars for a variety of reasons. And we don't see that changing necessarily overnight. That's not to say over many decades this can't change. But in the near term, it's the reason for using renminbi seems quite linked to the conflict and its current state of play, rather than a big shift in any of the very long-term factors.
Thanks, Manpreet. I guess we're going to keep getting more and more questions on that, and thanks for that update, Steve, there as well. Pratibha, as I pass on to you for taking on more questions, one of the things that is coming through is that given that you also oversee the advisory aspect within UAE and EMEA, is there anything that the team is doing differently in terms of client engagement to get the message that comes from Steve and Manpreet onto our clients, so that they can be more proactive in their portfolio rebalancing?
Thanks, Aisha, for that question. I think, there are a few activities that we've done ever since the start of the conflict, which is amongst the BAU activities that we've been doing. One is, of course, conducting these webinars. We've actually this is the third in a row that we've, carried out ever since the conflict started. The idea is to communicate our messaging and our thought process, during the whole course of the volatile market, so that people can take informed decisions. The second is that, our investment advisors and relationship managers have been in constant touch with their clients in order to get that messaging across. And especially where clients may have a slight or more exposure to some sort of risk, elevated risk in their portfolio, either through their fixed income portfolios or through lending in their portfolio or cross currency in their portfolio. So I think those have been conversations that have increased over the last few days. And of course, we've continued to elevate our communication with our clients by sending out a series of Market Watch communication that has been published by Stephen Manpreet and their team, which has been very, very regular through this entire conflict. So I would urge all our clients who are listening in as well to kind of get in touch with our relationship managers and advisors, because as we come to you with all of these views, we are also, enabling them with more and more of this communication, so they are very informed and they can take active participation in discussions and your decision making on your portfolios as well. Thanks, Aisha. So I'll, now pick up a couple of questions again, as you mentioned, since we kind of stopped off at currencies and we touched upon that a little bit. Maybe Manpreet, if you could maybe share views on two direct currency questions that we have here. One, of course, is the USD CHF pair, and also our views on the HKD.
So maybe I can start with dollar CHF, right? So I think dollar CHF, we've seen a bit of a rebound up into the 78 cents area, but that seems to have been entirely a result of some of the dollar strength we've seen, right, rather than necessarily anything changing on the Swiss franc side. But what that argues for is that in a base case scenario, if the dollar weakness does resume, then there's a good chance we see dollar CHF eventually start to move lower again. And a 12-month target there is closer to 74 cents, because once you move past the immediate pressures of the conflict, then that's an environment where we go back to discussing A, dollar weakness, and B, more sustained deflationary pressures on the Swiss franc side, which have resulted in higher real rates and that constant but slow but steady, appreciation pressure on the Swiss franc. So I think the Swiss franc, hence, I think the still rise in dollar CHF is temporary and a result of what we've seen in the dollar because of the conflict. But if we do get through this over the next few weeks, then it's likely we'll resume that downward move. That's slow but very gradual downward move in dollar CHF. So I think that's on that pair. I think on Hong Kong dollar, look, Hong Kong dollar is a peg currency within a narrow range, of course, and there is some volatility within that range. But that's something we don't necessarily expect any significant shift there, right? I mean, I know from time to time these questions about the dollar peg in Hong Kong do come up, and that they seem to come up at regular intervals. But we don't necessarily see anything, having changed, whether now or in recent years, to sort of change that situation. Because from a reserve perspective, the Hong Kong monetary authorities have more than sufficient, resources to keep the peg in place if they so choose to do so. So I think what's interesting about the Hong Kong dollar, of course, is because that imposes some bounds, does mean that presents a currency with much lower volatility, much more predictable volatility, especially if the question is, taking advantage of, bouts of lower interest rates in Hong Kong dollar. I think that's where it obviously looks quite interesting to add into the mix, as opposed to currencies like Swiss franc, where, of course, we expect currency strength to lean against any interest rate advantages.
Thank you, Manpreet. Maybe shifting focus to commodities, right? I know gold is a big conversation now. But really, gold fell sharply on Monday, down 4%, on Friday before that, and further pressured as the safe haven bid partially kind of unwound. Should clients be using this pullback to build or add to gold positions? What's our view? Manpreet, Steve?
Sure, I can start with, I think, Steve will add. No, I think what was most interesting about the fall in gold prices is that we saw it move exactly back to the 200-day moving average. And that's where it paused, and we've seen a bit of a rebound. And for those of you who don't follow, obviously, or don't take a deep interest in technical analysis, I guess that's a bit of a way of saying that gold had moved well above its steady long-term trend, and we've essentially just seen a fall back towards that trend without a significant break below that. And I suppose that's encouraging to some degree because that argues for this being a bit of a correction rather than a fundamental trend reversal. And then if you match that with maybe the fundamental picture that, look, our argument for gold was always based on, central bank demand continuing. And at the time being, at least, we don't see any reason for that having changed. Gold has grown as a share of central bank reserves, but, in emerging markets, that share still remains far below that of most of today's developed markets. So that argues there's still room for that share to increase. And the final point is that, look, even in a worst case scenario, let's say a scenario where a 30% scenario does sort of pan out and this crisis is worse than we all expect. In a stagflationary scenario or a period where we see high inflation sustained for a longer period of time because of oil prices, usually commodities like gold tend to do well in those environments. We look back at history. So when you put all of that together, I suppose it's a long way of saying, yes, this does look like an interesting opportunity to add where clients don't have that exposure already.
Thank you very much, Manpreet. Just back to the currency issue, right? So the USD strengthened sharply during the peak, but Monday's de-escalation should resume the dollar weakening trend that we're forecasting. If the ceasefire holds and the dollar weakens, what does that mean for EM bonds? I know we are overweight on them, but also on gold and maybe Asian equities in their portfolios. Is this now a time to rebuild non-US dollar exposures?
Maybe I'll take that and Manpreet can add, right? So, I mean, obviously that's been a theme that we've been talking about for about 12 months now. So remember we had that massive sell-off in the dollar post-Liberation Day, and people were very worried that the bottom was going to fall out of the dollar. Actually, we're back now to where we are almost pre that sell-off. So I think it's a great question. Our view is yes, gradually. I mean, we're not, as we discussed before, we're not through the current conflict, and the risk of further volatility extends to potential volatility in currency markets and maybe some dollar support. But the way we were positioning is selling dollars on rallies and investing into non-dollar areas on rallies as well. So emerging market local currency bonds is one area. So Manpreet talked about DM high yield and emerging market US dollar government bonds. But if you saw the chart as well with the yields, local currency bonds are also attractive. We've seen a significant repricing of interest rate over the course of the past month or three and a half weeks, as people sort of move away from emerging markets cutting rates to potentially even hiking rates. So that's obviously increased bond yields on offer. It's also weakened currencies in many instances as well. So it is an attractive area. And then Asian equities, actually, interestingly, still have outperformed this year. So yes, they've underperformed since April 20. Sorry, I keep saying April, since February 27th. But still they are actually up. I think I looked this morning around. Before today, they're up 3.5%. So today they've been up around 2%. So probably over 5% year to date. But yes, looking at this as an opportunity to add to Asian equity portfolios as well.
Thank you, Steve. Just a couple of questions that I'd like to pick up from our clients posing on the Q&A chat. What are our thoughts on the disconnect between the physical and futures markets for oil? Is there really a good hedge in the oil space if moves aren't being properly reflected within futures?
So I guess there's the question as asked, and there's also an element that Manpreet and I were talking about earlier in terms of whether energy stocks also now offer a hedge again, because we did very well by recommending energy stocks as soon as everything broke out. I think energy stocks went up 30% plus or something like that in a very short period of time. And then we were like going, they're not much of a hedge anymore, but they're started to cheapen a bit again. But on the question itself, look, markets are always trying to predict the future. What the futures market says and what actually happens rarely actually aligns, right? So it's obviously a tug of war between those who are worried about this being a sustained conflict and those who think this is going to blow over. I think the way we would view it is, it depends on the size of exposure you've got and the sensitivity you have to that exposure more than trying to give a forecast on the oil price itself. So if you think if a $10 rise in oil prices would be really, really material for your business, then yes, looking at the futures, maybe it's a good idea to have at least partial hedge in place to bring that down to manageable levels. But our central scenario is that we do go back to sort of $70 to $80 a barrel over the course of the next 3 to 6 months. As I say, it won't be a smooth process, and that's not too inconsistent with what the markets are saying today.
Thanks, Steve. Just going back to currencies again, I know that's a popular one today. Could we have views on US dollar, Sing dollar, and does it make sense to have more investments in SGD considering the dollar view? And also, if I can go back to the CHF piece, will the Swiss Reserve Bank try to depreciate the CHF value because of the big impact it has on their export?
So maybe I'll take the dollar Sing, and then Manpreet can talk about the Swiss franc, right? So obviously, if the dollar was to weaken, then we would expect dollar Sing to come lower. So we're trading around 127. The central bank here does sort of manage it on a trade weighted basis. But the lows were just below 126 earlier this year, and they do manage inflation in a way that it's below its partners. So the tendency is over the long term for the Sing dollar to appreciate it on a trade weighted basis and against things like the US dollar. So that's the currency view. The problem is that financial markets here are fairly shallow. Right, so if you look at the Sing dollar bonds, it's a very limited universe. Manpreet used to run our fixed income strategy team, and he knows that all too well because a lot of people want to buy Sing dollar bonds, but it's actually a fairly limited universe. And on the equities side, it's very skewed towards banks and also REITs. So from that perspective, it's we actually have an underweight, I think, towards ASEAN equities. So we have an overweight towards Taiwan. And India and China. So those are the sort of three markets that we like within Asia. But Singapore doesn't come top of that list just because of its composition is quite defensive, boring, and we think there's better alternatives elsewhere.
Mute. I think when it comes to dollar Swiss, look, of course, if you were to ask the Swiss National Bank today, they would favor a weaker Swiss franc, as they have been favoring a weaker Swiss franc for quite some time now. The challenge, of course, is that central banks don't always get what they want, particularly when it comes to currencies. And the Swiss National Bank is not the first one to discover that. And what we know is that intervention, rarely has a sustained impact on currencies that are long-lasting unless a very well-coordinated effort. I think the Swiss National Bank's real incentive here is to deal more than exports, but really to deal with deflationary pressures because inflation is very, very low. Headline CPI, if anything, is slightly negative. But on that, arguably, trying to influence the euro-Swiss exchange rate is, if anything, a little bit more important than dollar-Swiss. So I think you've got a central bank which, yes, who would ideally like a weaker Swiss franc, but I think there are several constraints around it, including the cost-benefit trade-off of potentially even exploring negative interest rates. And I think that's why we have not seen, the extent of Swiss franc weakness as they might have liked, and as much as they might have liked. So yes, don't disagree with it, but I think on balance, particularly in a world of a weak dollar, which is our baseline expectation, we still think when it comes to dollar Swiss, chances are that the pair moves lower rather than higher.
Thank you, Manpreet. Steve, Manpreet, thank you very much for your time. I know we've already passed the hour, and you've brought a lot of clarity to what has been an incredibly complex and fast-moving situation in a market environment this volatile. Having a clear framework and a considered point of view is invaluable. So I think this has been incredibly useful. So thank you very, very much. And over to you, Aisha, for your closing remarks.
Thank you very much, Pratibha, Steve, and Manpreet. That's been an incredibly useful conversation with our clients here in the UAE. We are going to come back again, hopefully, to see yourselves in person as the situation unfolds in a positive way. And otherwise, we'll be delighted to meet you again over a webinar to continue this conversation. Some of the questions that have come through, we've not been able to answer. We are going to come back to you separately. Please do reach out to our investment advisors and our relationship managers should you still have questions, and we'll go back to Steve and Manpreet and get those for you. Thank you very much. Thanks, Steve. Thanks, Manpreet. Thanks, Pratibha, and all who've joined the call today.
Thank you so much.
Goodbye.
Take care.
Thanks. Take care. Bye-bye.